Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her website, jugglingdynamite.com. Welcome back to the show, Danielle.
Hey, thanks, Jim.
Danielle, the widening wealth gap. So many people at the lower end of the economic spectrum laid off due to COVID. Those, in the health sector, government, and management still doing pretty well. Is this going to hurt our economy in the long run?
Well, yeah, it's hurting our economy on a bunch of ways, but some of them will be more durable than others, right? So it's interesting that we've had the summer bounce, so to speak, when there was reopening and numbers were lower coming out of the spring rush for the virus spread, and people adopted, mask wearing, social distancing, hand washing, those tried and true tools to help spread control. And then, of course, as soon as things look like we're getting ahead of it, people sort of are more lax in their efforts, and they start getting back together. We're reopening. We're seeing this all over the world. It's interesting. There's no magic bullet, right? And there's no place that's different or separate from. Like, everyone that didn't have outbreaks was because, no one had come there with it or brought it, or, they were effectively distanced. And then as soon as someone comes into the community, it spreads like wildfire if you aren't doing those things, right? So we're seeing that now in spades. I mean, we are having about 500,000 new cases globally every day of the virus, and 4,000 new cases yesterday in Canada alone. Ontario, Quebec, pretty much every province out to BC is now seeing this. So we're having a difficult, we're entering a very difficult period here with the weather turning winter and people having to, go inside and not see each other more. And it's challenging because people are already kind of over this, they're sick of it. But the fact is that we don't yet have an effective vaccine. And although there was a lot of news this week, and a lot of optimism around the Pfizer announcement and others, I think we've really kind of got ahead of ourselves here. The fact of the matter is that this is going to be an issue for probably the next year. Even if we get this vaccine approved, invention is different than distribution. Distribution requires a couple of shots. It's going to require a period of time. There's issues around the temperature, that this particular vaccine has to be kept at such a cold temperature. It's very difficult to transport. So I just think that, we're in a marathon here, and people are programmed to like sprints. So they like to have, a sort of oh, thank goodness it's fixed. But I don't know that we'll ever truly be fixed on this particular issue. Look at the diseases that are spreading just in the last year because we've been, diverted our attention towards COVID. We're having a rise in other problems like measles, for example. I don't know if you noticed that in the news, but a bunch of people haven't been getting the vaccination worldwide for measles, which, by the way, took several years to develop the measles vaccine. And although it's very effective, as soon as people stop, diligently inoculating for that disease starts to become a major problem again. So I think we're going to always have this recircling virus, and even Dr. Fauci said that even if we have an effective vaccine administered to a wide population for COVID, it'll probably still always be around. So I think we have to really think of this as how do we do long-term investment, things that will help us revamp perhaps some of the ways that we conduct ourselves in the economy, some of our social habits, are probably going to be forever changed. And of course, yes, there are a good amount of people working from home and who are able to, or are still in demand and busy in this environment, but there's that whole portion of the economy which is really going back into another shutdown here. And the statistics, as I've mentioned before, small businesses really are the bulk of the employers in the economy. And we're seeing, the numbers of them who believe that they can survive this second shutdown phase that we're now entering, is, something like 60% of them are hopeful that they can survive and 40% are saying that they won't be able to survive. So this is a major headwind for the economy. And, the latest, person who's been, the new people who have been appointed for the incoming Biden administration, some of the infectious disease experts, they're saying, we're heading into the darkest phase of this now. And that was forecast for some time, right? Last spring, there was a lot of talk about, as people come outside in the warm weather, it'll get under control again, but be aware we're in for a rough patch starting in the fall. So none of this is really surprising. Although some people seem to be very surprised that we have to do the lockdown measures again. But I think it's essential. And this idea that you choose the economy ahead of the virus or the lockdown is really, a spacious argument, because the fact is that if we don't get the virus under control, we will never get the economy back into a healthy place, So it really isn't a choice of one over the other. One really does have the upper hand, and that's the virus.
We'll have more with Danielle Park right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Danielle Park. With so many economies now being clamped down again, is this going to be one of the most dismal Christmases ever?
Well, I guess, obviously if you're ill or you're not able to see your loved ones, that could be a very negative time. But I think, mental training for our expectation of what adversity is important. For many of us, we have never seen anything like this in our experience or in our lifetime. And so this is our idea of, real adversity. But I think that people who've come through war zones, war times, other past pandemics, that are much, in other parts of the world, understand that relatively speaking, if you can't get together with your family at Christmas, it's not really the end of the world. So I think we have to really keep a good mindset about this. The strains are really going to be, the mental health strains, the financial strains, and those are very real, and we have to be very cognizant of what we can do as a community, as a society, to help each other and to help with financial support so that we can get through this period. I think everyone's very optimistic that, of course, someday we will, no longer be shut in by, COVID-19. But having said that, there's still a lot of distance between when that period will be and now. And so I think, mental health training is really important. People can do all sorts of things to keep their physical health, how they're eating, how they're sleeping, how they're treating themselves. Meditation is a very popular thing right now. There's all sorts of things we can do to keep this sort of in perspective and to keep ourselves in that mindset of we will get through it. It is a marathon, and we will just keep moving forward.
Moving on to something maybe that could help people. should you be reassessing the withdrawals you make from your so-called super assets right now?
Well, so there's a whole bunch of layers there. I mean, the fact is that people have been overly optimistic about what sort of income withdrawals they could sustain in retirement for a number of years now. I've been pointing this out for some time. Basically in the last 20 years, the expected returns have been falling as asset prices have been getting more and more surreal in their pricing. And so the yields that people could take off of them have been going down. At the same time, as you know, interest rates have been falling. And that's what you call your safe withdrawal rate. In retirement, it's typically, people may have a portion of their money in equity and risk assets when they're working and still in the savings portion of their life. But once they move, within 5 years or so of their retirement and indeed into retirement, they really can't afford, if they're looking to take a regular income to support themselves through their retirement, they can't afford to have a bunch of wild swings in their base capital, so to speak, and they don't have a lot of time to make back losses if they have them to their principal. So it makes everyone much more risk averse. It should. That's the natural, healthy thing to be. And so you have to look at, again, safe withdrawal rates from things like GICs, government bonds, the things with the least credit risk. Back in, 20 years ago, 10 years ago, safe withdrawal rates were sort of 5%. That was the expectation. But as yields have fallen on those deposits from 5% to less than 1% today, people have not adjusted their withdrawal expectations down accordingly. And really what that means is that if you're, needing a certain level of income, you need a lot more principal today than you did 5 and 10 years ago to produce that same safe withdrawal rate. So really it is a function of people having to rethink their plans about whether they work longer, whether they figure out a way to downsize their needs and their expenditures in retirement. But the idea that's commonly peddled as the solution is to increase your risk exposure, to buy more of the least principal secure assets to try and provide a higher yield. The problem is that even there, as I say, as long as prices of the risk assets are still, unreasonably high, the yields are inverse to the price. So the income that you're going to receive from something when it's, highly valued is going to be much lower than if the price has come down significantly. An easy way to think of that is with rents. If you pay a fortune for a rental property, the rents that you can collect off that for the capital outlay are going to be less than if you buy it at a discount or at a relatively low price for the house. The rents can give you enough yield to not only pay for the costs, the financing and the maintenance of the property, but actually net profit. So that's the kind of thing that price really impacts, and it's very important for people to not just take these plug-and-play ideas that were from a different period when we had entirely different yield prospects. And unfortunately, the financial advising community is still doing that. They're still telling people, oh, sure, you can take 5 or 6% a year out. If you have $1 million, you can take $50,000 or $60,000 a year of income off of that. When in reality, if you can take about 2 or 3% today as a rule of thumb on withdrawal, that would be the maximum that you should think about. And there's been a lot of studies done on, if you don't adjust that, and if you go into, just as an example, if you go into retirement with asset prices, let's take equities, which is what people typically look to supplement. If fixed income is yielding too little, they say, well, let's buy equities that pay dividends. And so they look at, historically, if you look at that, when you purchase equities when they are, in the sort of bottom third of valuation, historical valuations, in other words, relatively cheap, relative to historic levels, you find that you have an 80 to 95% chance of, outliving your principal in retirement if you're making a 5% annual withdrawal. So there's your base of capital, you're taking out 5% a year, and, you have a very high probability of that capital lasting throughout your lifetime. If you go into it, however, when you're buying or holding equities at levels like now, when asset values are in the top 10% of historical occurrences, you have much less than a 50% probability of having your money last your whole lifetime. In fact, when you're, it's probably more like a 30% chance that plan is going to work and a 70% chance you're going to outlive your money, which is not a comfortable idea or plan for anybody. So I think it's really important. Right now what we're seeing is this rotation in markets where, there's been relief about some kind of transparency coming in the U.S. election, or some kind of an answer coming, although it's not entirely settled yet. It's, for all intents purposes, pretty clearly settled. We've been through this period of great chaos. The Trump administration was all about chaos, right? And chaos is not good for getting work done. And we've got some really serious work to do on so many levels in the world, so many intelligent things we should be moving forward with. And so, on the one hand, getting through the election result and moving to a state of more focus on work and less chaos is going to be very positive, as well as if we can get some kind of a vaccine. Obviously, that's very positive. But I think that we're really getting ahead of ourselves here in terms of financial markets again. The great casino rallied so strongly on this, for example, the news of this vaccine that's not here yet, that is hoped to be available, sometime in 2021. And you see a rotation of people leaving the tech stocks, which have been the tech bomb like in 2000, similar to the last couple of years where they've been trading at just ridiculous valuations. And so you see this rotation from them into more dividend-paying stuff, right? And so this is this type of cycle where people think, okay, so now we have to look at, hopefully if we're having a repricing in economic growth is going to be difficult for some time. Hopefully dividend-paying stocks will be more defensive. What they mean is hopefully they will lose less in value. And if you're looking at things like tech stocks today, that will likely lose 70 to 80% of their value as we go into the mean reversion phase of the cycle, which is overdue. You could also see dividend-paying stocks fall 30 to 40% from here. So you have to always be careful when people talk about, this dividend-paying stocks as some solution to retirement income or a more defensive play when you're into a bear market in overall equities. They always mean relative to tech stocks, yes, they may lose less, but relative to your principal, losing 30 or 40% would still be devastating, especially for people as they are later in their savings life or into retirement. So all these things are really relative, and there was a study that was released this week from Prosper Canada, and it was really looking at how poor information Canadians have available to them, how much they are given bad financial advice or no financial advice from any sort of realistic perspective. It's always from the sales side. How do we get people to take on more loans or take on more risky assets, buy these financial products that produce fees for the industry, instead of how do we help them plan their life so that they have good personal discipline, so that they have more safety or protection against life's unexpected or even predictable events. And so that's the kind of thing people really need more of, is just this really down-to-earth looking at their actual numbers and coming up with practical plans.
And Danielle, you'll have some practical tips for us when we return.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, I noticed on your blog you had 3 points you'd like to make to people if you want to have a healthy retirement or even a healthy financial life now. What are those 3 main tips?
Well, it's this article that I was referencing on the blog was actually written by someone else, and it was talking about how old are you financially. But this is the type of thing that I talk about a lot. In other words, how old are you financially was really about the maturity level of your understanding or your personal behavior, your discipline around money, and how, it's very common for people to not have good insight when they start out working or, beginning in their early spending years. And depending on whether or not you had wise counsel around you or whether people were able to help you with with wise counsel and you were able to take it, all those things can impact how quickly we catch on, so to speak. So living below your means, spending less than you make, saving from your as a regular discipline from your income rather than spending everything, setting up emergency funds, and then not losing the principal once you get it. That is so critical, and that is the piece. Not only do people, and that's connected with the lack of savings or saving too little. People have an unrealistic idea of how much savings they're going to need to amass to pay for a certain life that they hope to have. And they are sort of thinking always that big incomes solve problems. Big incomes can solve problems if you're spending less than you earn and you're saving, but not if you're spending tons. And if you even look at the highest income earning families in Canada, the top 10%, 80% of them are still in debt, and that includes mortgage debt, but also car loans and all sorts of kinds of debt. So there's this, the most indebted families have the highest income. Then that may sound all very sustainable, except when something happens to one's income, or they get closer to retirement and realize that they have, a fraction of the money they're going to need to produce the income they were hoping. So it's very important that people get very practical advice about that personal discipline piece, because really no amount of income can make up for it if you don't have it. And if you are risking your principal and losing big chunks of it, you're really defeating any opportunity for compound growth over time. And that's very little understood as well. It really means that you have a buffer of cash so that if something is to happen to your income or an unexpected emergency or expenditure arises, that you don't have to go into debt in order to fund it. So, there's various recommendations, whether that would be 6 months of income, 3 months of income. Obviously, as much cash as you can have available, the better. But it is something that people should be thinking about. And again, this goes back to when people are looking for financial advice, they too often present to a bank who says to them, hey, you've got this $1,000 in your savings account, why don't we put it into some mutual funds? This is a totally different bucket. Right? This is what I talk about a lot. You need, the first focus should be on having some cash for emergency circumstances that could arise to help you get through rainy days, so to speak. The second thing is to get rid of your debt. That's a huge part of everyone's financial challenge, and they need to pay for the things they have without taking on more debt. If they can get a shelter paid for, that needs to be a primary focus. And that means that while they're doing that, they're not having funds to spend on more consumption, and they're not having funds to put into other savings, right? So they have to really get that goal accomplished first, and then they start moving into the long-term savings bucket. But if you don't get to that until you're in your 50s, the amount of money that you're going to have to save to catch up is going to be pretty daunting. So it's really a function of making sure that you keep the retirement bucket potentially for, a longer term view is where you can look at different types of investments, but again, always with the view to not blowing the principal up, because once you do, you've really set yourself back years again.
Danielle, thank you so much for chatting with us.
Okay, thanks, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite, her website jugglingdynamite.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.